Today we're exploring some of the best price action strategies. No clutter, no indicators, no lag, just pure price action. We'll start with the engulfing momentum candlestick. This signal occurs when a large candle fully engulfs the body of the previous two candles. Basically, a big candle that completely covers the smaller ones right before it. This isn't just a regular occurrence. It's a sign, a clear indicator of a strong move in the market. This is what we call an engulfing pattern. The psychology behind this pattern is all about market sentiment and the sudden shift in the balance between buyers and sellers. Before an engulfing pattern occurs, there usually is a clear trend. This trend indicates a prevailing direction where the majority of market participants are either buying or selling. At some point, the market starts showing signs of exhaustion. For a bullish engulfing momentum bar, this might be at a support area or at a demand zone where buyers believe the price is attractive enough to start buying in large quantities. For a bearish engulfing one, this could be at a resistance or at a supply zone where sellers feel the price has peaked and it's a good time to sell. The engulfing momentum candle represents a strong shift in sentiment. If it's bullish, buyers have overwhelmed the sellers, pushing the price up and covering the range of the previous two candles. This suggests that the demand has suddenly outstripped the supply. In a bearish pattern, sellers have come in strong, indicating an excess of supply over demand. The immediate effect of an engulfing momentum bar is to signal a potential reversal. It shows a decisive change in market dynamics. For bullish signals, it could mean the end of a downtrend phase, with prices likely to rise. For bearish ones, it could suggest the end of an uptrend wave, with prices expected to fall. For the engulfing momentum pattern to be a reliable signal, it should ideally be accompanied by high trading volume. This volume is the evidence that a significant number of traders have participated in creating the candle, thereby validating the shift in market sentiment. And please wait for the candle to close to confirm the signal. Prematurely reacting to what looks like an engulfing momentum pattern can lead to false signals if the candle does not close as such. The psychology of this signal revolves around the trader's perceptions of value and momentum. In a demand zone, seeing a bullish pattern might lead buyers to believe that the market is turning in their favor. Hence, they buy more, driving the price up. In a supply zone, a bearish pattern might scare off buyers and encourage more selling, pushing the price down. A breakout buildup occurs when the price action compresses, indicating a balance or a struggle between supply and demand, before one side eventually takes over, leading to a breakout. The market structures itself around various phases, which include accumulation and distribution. During the accumulation phase, you often see smart money buying up the available supply without causing a significant price increase. In contrast, the distribution phase occurs after the price has risen and smart money begin to sell their positions, quietly and slowly. A breakout buildup typically forms during these phases. The price action during a buildup appears as a tight consolidation, where the price moves in a narrow range. This consolidation suggests that neither buyers nor sellers are in full control, but both are actively involved. During this phase, the volume often diminishes, which might seem counterintuitive. However, this decrease in volume is a key indicator of a breakout buildup. This is because it suggests that traders are waiting on the sidelines, watching closely for a sign to enter the market. In a breakout buildup, the price action doesn't make big jumps. It moves slowly, hugging close to a key price level, like resistance or support. This slow tightening movement is often called coiling, and a coiled market holds potential for a significant price move. Traders are watching closely, but they're hesitant to commit fully, not until a clear signal appears. This decrease in volume and smaller price range is a sign of weakening momentum in the current trend. It's like the moment of silence before the storm. The real action happens when there's a breakout, a strong price move, out of the coiling pattern. This breakout can happen in either direction, but it typically follows the prevailing trend or the pressure from the dominant market side before the build-up started. For example, if the build-up occurs near a resistance level after a strong uptrend, the breakout is likely to push upward, continuing the trend. However, not every build-up leads to a breakout. Sometimes the price might just hover around the level and then drift away without any significant movement. This is why it's important to wait for the breakout before making a trade. Confirmation could come in the form of a price action signal closing well beyond the level, or an increase in trading volume that supports the direction of the breakout. Bull traps and bear traps happen every day, on all markets and all time frames. They are essentially false breakouts of major and minor levels, where the price quickly reverses. A bull trap occurs when traders are misled into thinking that a rising price will continue going up after breaking above a resistance level. However, the price reverses and drops instead. A bear trap happens when the price breaks below a support level, suggesting a further decline, but then it reverses and rises. To find these traps, you can start by looking for a breakout that lacks conviction. This might manifest as a price that moves beyond an obvious level, but with low volume. If the breakout volume is suspiciously low, this could be a trap. Next, observe the price action around these critical levels. In the case of a bull trap, you might see the price pushing through a resistance level, but then quickly pulling back and closing below it. This indicates that the buyers could not maintain their strength, and the sellers are taking control. For a bear trap, it's the opposite. The price might dip below a support level, only to rebound and close above it, showing that the sellers are losing their grip and buyers are stepping back in. Another technique is to analyze the market structure. False breakouts often occur in ranges or during periods when the market lacks a clear trend. If you notice that the price is breaking out of a range, but the overall market conditions are not supportive of a strong move, this could be a setup for a trap. It's also useful to track how often a specific level is tested. A genuine breakout might initially retreat back to the breakout point, but it usually won't penetrate back through it. If you see the price breaking a level and then retesting it multiple times, be wary. This could indicate that the breakout doesn't have enough strength and might reverse, signaling a potential trap. Now, before we continue, let us know in the comments what topics you'd like us to cover. Tell us what you want to watch next. The long wick engulfing candlestick is my favorite price action strategy. This candlestick not only indicates a strong rejection of prices, but also signals potential momentum shift in the market direction. This candle typically shows a large body with a long wick that extends far beyond the body's edges. The engulfing part means that the body of this candle is larger than the body of the previous candle, completely overshadowing or engulfing it. This visual on your chart is your first clue about a significant shift in market sentiment. The long wick represents a point where supply surpasses demand, pushing the price back down, or vice versa, depending on the direction of the wick. Let's say the long wick is at the top of the candle. This suggests that as the price went up, it hit a level where sellers were waiting to take profits or considered the price too high, outweighing buyers. This results in the price being pushed back down sharply, leaving behind a long upper wick. The rejection indicated by the long wick is significant because it shows that a certain price level could not be sustained. Buyers tried to push the price up, but the overwhelming number of sellers at that level rejected this move. If the candle also engulfs the previous candle, it shows increasing selling momentum. Despite any buying pressure that might have been present initially, sellers took control and managed to push the closing price below the open one of the previous candle, indicating strong supply. If the wick is at the bottom, it means sellers drove the price down, but buyers stepped in, finding the lower price attractive, thus pushing the price back up, showing rejection of lower prices. If the body of the candlestick also engulfs the previous candle, it suggests increasing buying momentum. Buyers were not only able to overcome the selling pressure indicated by the long upper wick, but were also strong enough to close the candle higher than the previous candle's body, indicating strong demand. This is a powerful price action signal. It provides a clear signal that the market sentiment might be changing direction. Look for these patterns at major resistance or support levels, because they can signal the end of a trend or the reversal of a price direction. A bullish long wick engulfing candle at a key support level might suggest a potential upward reversal, tempting buyers to enter the market expecting future gains. The no retest breakout is a must-know signal. Imagine a scenario where the market has been trending upwards, and suddenly a breakout occurs. Unlike many breakouts that might retest the breakout level, this one doesn't look back. It just keeps powering through with intense momentum. This is a no retest breakout. First, let's consider the price action psychology after and before such a breakout. Many traders are watching the same resistance level. Some might be waiting to buy just after the breakout, believing that the price will continue to rise. Others might be skeptical, holding off on buying until they see a retest of the level to confirm it as a new support. Now, when the price breaks through the resistance level with strong momentum and doesn't retest, two main groups of traders are significantly impacted: those who missed entering at the breakout, and those who bet against the breakout, assuming it wouldn't last. For those who missed the breakout, the pain begins as they watch the price move further and further away from the breakout level. They were waiting for a dip, a retest, that never comes. This situation creates a psychological urgency, a fear of missing out, prompting them to consider entering the trade at much higher prices than they initially planned, often pushing the price even higher. On the flip side, consider the traders who took a short position, betting that the price would not sustain its breakout. As the price climbs higher, these traders find themselves in a losing position. The psychological discomfort, the point of pain, is located at the breakout level. The plan here is to focus on the moment the price finally returns to the initial breakout level, the point of pain, which is a critical moment for both groups of traders. For those who were waiting for a retest to confirm their buy, this might be seen as a second chance to enter the trade. And for the traders who are trapped in a losing position from their shorts, this is an opportunity to exit at a break-even point, or at least minimize losses. The return to the breakout level will often trigger a surge in trading activity. This can lead to a sharp price reaction. However, the reaction at the breakout level isn't always predictable. If too many traders are looking to exit their positions, both longs taking profits and shorts covering losses, the supply might outweigh the demand, leading to a price drop instead. So don't expect a major price swing at the point of pain. You will see a reaction, but it won't be that explosive as the first one. When you see multiple rejection wicks and candles are changing their color, you are witnessing a strong signal. In this example, observe these two consecutive candles at a similar price level, where the first is bullish with a long upper wick, followed by a bearish one with a similar long upper wick. This formation can tell you a lot about what's happening in the market. Starting with supply and demand, the first candle, the bullish one with a long upper wick, indicates that buyers initially pushed prices higher. The long upper wick shows that as the price reached higher levels, an ample supply emerged, overpowering the buyers and pushing the price down from its peak before the candle closed. At these higher price levels, sellers are more than willing to step in and take control. Now, when the next candle opens, it starts where the first one left off, but turns bearish with a long upper wick as well. This second candle confirms the presence of strong selling interest at these levels. The fact that this candle is bearish and mirrors the wick of the previous bullish candle, it intensifies the signal. The sellers are not just reacting spontaneously, they are firmly establishing their ground, showing that they are prepared to sell at these prices, thus increasing the supply. The repeated rejection at this price level signifies that the supply has surpassed the demand, possibly leading to a trend reversal or at least a significant pullback. From a psychological perspective, this signal plays a vital role. Consider the first bullish candle. Traders who bought during or just before the high might have expected the momentum to continue. The subsequent price dip could lead to a change in sentiment from optimism to concern or even fear. This emotional shift is crucial, as it might prompt those buyers to sell quickly to cut losses when they see prices failing to go higher, which adds to the selling pressure. If this pattern appears at a known resistance level, the message it sends is even stronger. Traders often place their stops around these levels, and the activation of these stops can accelerate the price movement downward as the bearish sentiment takes hold. The next strategy involves choosing the correct supply and demand zones. During uptrends, demand levels are respected and supply zones are taken out. This phenomenon occurs as buyers gain confidence and control over the market. This buying pressure gradually outweighs the selling pressure, leading to a sustained rise in price. In this phase, when price retraces to a lower level, a demand zone, it finds strong buying interest. These zones are where buyers previously saw good value and are likely to engage again, believing that the price will continue to rise. The respect for these demand zones during an uptrend is due to the trader's psychology of buying on dips. They perceive these pullbacks as opportunities to buy at a lower price in a market that is overall ascending. As the price reaches new highs, it encounters supply zones. These are levels where the price was previously sold off, and potential resistance might exist. However, in a strong uptrend, these zones are often breached. This breach happens because the ongoing positive sentiment and the buying pressure overpower the sellers waiting at these levels. Each time a supply zone is taken out, it reinforces the bullish sentiment. It's a psychological reinforcement loop. Breaking through supply zones builds more confidence among buyers, drawing more participants into the market. The point is, during uptrends, don't even try to trade supply zones. Focus only on buying on dips at demand zones. During downtrends, you'll see that supply zones are respected and demand zones are taken out. When the price goes up to test a previous high, a supply zone, it often finds strong selling interest. Traders who missed selling during the initial drop see these rallies as second chances to sell. So supply zones gain respect. They act as barriers preventing the price from rising further because the prevailing sentiment is bearish. Traders expect prices to go lower, so these zones are defended by selling. On the other hand, demand zones, which supported the price on its way down, start to break. As the downtrend deepens, each rally is weaker, and previous demand zones fail to hold because the selling pressure continues to mount. The failure of these zones is due to a shift in market psychology. The fear of further declines becomes more dominant than the desire to buy at lower prices. Thus, these demand zones are taken out, leading to new lows. Each breach of a demand zone further demoralizes the buyers, reinforcing the bearish trend. So during downtrends, ignore the demand zones. Focus only on selling at supply zones. The over and under pattern is one of the most effective price action strategies. This pattern essentially signals a critical shift in the market dynamics, hinting at a potential weakening or reversal of a trend. So in any trading market, prices are driven by supply and demand. These forces are represented by the actions of buyers and sellers who push prices higher or lower. A trend, whether up or down, continues as long as there is an imbalance favoring either buyers or sellers. For example, in an uptrend, buyers prevail, consistently willing to buy at higher prices, thus creating a sequence of higher highs and higher lows. The over and under pattern comes into play when there is a noticeable shift in this trend structure. When the price suddenly drops below a previous major low and then makes a lower high, it suggests a break in this structure. This is the first clue that the prevailing buying pressure is weakening. The scenario is similar but reversed in a downtrend, when prices push above the previous low but then form a higher high. It indicates that the selling pressure is diminishing. Let's consider the psychological aspects driving this pattern. In an uptrend, as the price drops to form what initially appears as a normal pullback, buyers are typically prepared to jump in, anticipating another push to higher highs. However, as the price fails to reach a new high and instead falls below the previous low, it disrupts the expectations formed by the market participants. This unexpected change often leads to uncertainty and a shift in sentiment, causing some of the buyers to step back and reassess their positions, while potential sellers might see an opportunity to enter the market. The pivotal moment in the over and under pattern is when the price breaches a significant level. This action is a powerful signal because it challenges the established market structure. It's not just a simple breach, it's a signal that the previous consensus is no longer valid. This can lead to rapid shifts in supply and demand. Buyers who were previously supporting the price by buying at dips might pull back, and sellers may start to dominate, pushing the price down further in what was an uptrend. From a supply and demand perspective, this pattern reflects a shift in the balance. The initial move past the previous high increases the demand suddenly, but this failure to continue in the same direction indicates exhaustion and a possible reversal of roles between buyers and sellers. Another important strategy is the weak break of structure. This signal is subtle but powerful. Now, a weak break of structure occurs when the price marginally surpasses a previous high in an uptrend or a low in a downtrend, but fails to sustain this momentum and quickly retraces. This scenario often indicates that the market does not have sufficient conviction to support the new highs or lows, leading to what we call a weak break of structure. In any market, price movements are fundamentally driven by the imbalance between supply and demand. A weak break of structure typically occurs at points where this balance is delicate and easily disrupted. Consider a scenario where a price level has historically acted as resistance. As prices approach this level, sellers begin to dominate the market, believing that the level will hold and prices will drop again. Buyers, on the other hand, push the price up, testing the resistance. If the buying pressure is strong enough, it might initially break the resistance level. However, if this break is weak, meaning it only goes slightly above the resistance level and quickly retraces, it suggests that the buying pressure was not truly powerful enough to shift the market sentiment decisively. The sellers still have substantial influence, and the demand was not sufficient to maintain the higher prices. If the price cannot sustain itself above the previous resistance, it indicates that demand is weakening. The price often falls back to lower levels as sellers regain control and buyers withdraw, waiting for more favorable conditions. One instance of a weak break of structure may not be meaningful, but consecutive weak breaks of structure can form a pattern that highlights a significant loss of momentum. For instance, if the market attempts to break a low multiple times, but each time only succeeds marginally before retracing, it suggests a consistent lack of supply at lower price levels. This scenario often precedes a stronger move in the opposite direction. Consecutive weak breaks will allow you to anticipate potential market turns. The next strategy involves finding instances of momentum gain and momentum loss. Momentum refers to the speed or strength of price movements, and this can be observed through the lens of consecutive candles, increasing or decreasing in size from a supply and demand perspective. When you see consecutive candles getting larger and larger, this usually signals a momentum gain. Imagine a scenario where each candle represents a day of trading. If each day the price moves higher than the previous day, and the size of the candle gets bigger, it indicates strong buying pressure. More buyers are entering the market, willing to buy at even higher prices. This buying pressure pushes the price up, creating larger bullish candles. This can often be seen in an uptrend, where each candle is getting larger and moving a greater distance per candle, showing a gain in bullish momentum. The increasing size of the candles indicates that buyers are becoming more aggressive. Momentum loss can be found when the candles start to decrease in size. This suggests that the movement in price is losing strength. If you observe that after a series of large bullish candles, the candles begin to shrink in size, it could be a warning sign. Shrinking candles suggest that although the trend is still upward, the buyers are not as aggressive as before. The distance traveled per candle gets shorter, signaling that the buyers are losing control, and the bullish momentum is weakening. This shift could be due to various reasons, such as traders taking profits after a price surge, or simply the market running out of steam. When buyers begin to pull back, the supply may start to match or exceed the demand, leading to smaller price movements. Momentum loss is not only about shrinking candles, but also about where these candles appear. If this pattern occurs after a prolonged uptrend at a key resistance level, it could be a strong indicator that a trend might reverse or at least stall. This is because at resistance levels, the price has historically struggled to move higher, and with weakening momentum, the likelihood of breaking through these levels decreases. The plan here is to ride the wave of increasing buyer enthusiasm during momentum gain phases. On the other hand, noticing a momentum loss with decreasing candle sizes could signal a time to be cautious. Volume will confirm or contradict the momentum signals provided by candle sizes. Increasing volume alongside larger candles reinforces the momentum gain, suggesting strong buyer commitment. If candle sizes diminish and volume decreases, this further confirms momentum loss, indicating that the interest in pushing the price higher is decreasing. Now, if you liked what you saw, we have plenty more interesting guides for you.